Welcome to the channel. I'm James, and today we're looking at the Home Depot Inc. ticker symbol HD. They have just released their earnings this morning. We are going to be going through them today, then giving my updated fair value of the company using discounted free cash flow and the Buffett-Graham intrinsic value models based on these earnings. So is this stock a buy in 2022? That's the answer I'm going to hopefully give you guys today. So firstly, what has happened with Home Depot? You can see the market has reacted pretty poorly, down 8.85% to 316. Give me a hell yeah. Jokes aside, the stock is still down 9% on the day, 315 now, so I can't make my joke. Down from its all-time highs of about 419, which was in January. So that means it is down massively on the year, about 23% on the year. But that's the year to the day. The entire year, it's still up about 19%. So let's just get straight into it. Home Depot beats estimates. Retailer says it sees sales growth ahead for 2022. The sales grew 11% and it's beat Wall Street expectations. And also they have a new CEO, the previous COO, Ted Decker, as of March the 1st. Let's just get into some of the highlights here. Well, they did beat earnings per share, $3.21 versus $3.18. So beat there. Revenue, 35.72 billion compared to 34.87 billion. That is up. And you can see that net income also grew and net sales grew. So overall looking very good, but the market hasn't reacted too positively to it, down 9% now. So if we get to those earnings, we have the 3 months ended on the left and the entire fiscal year on the right. So firstly, I like to look at net sales. Is net sales increasing for the quarter? Yes, it is. 32.2 billion compared to 35.7 billion. So that is up about 10%. And the revenue for the year, 132 billion in 21. 20 billion more, 151 billion, which is about a 14% increase. So that is looking promising. Next, we like to look at the earnings, which is basically cost of sales minus operating expenses and everything else. We can see that the cost of sales is up on the year, 87 billion to 100 billion. But overall, if we get to the very bottom, what has the net earnings done? 2.8 billion in 2021 compared to 3.3 billion in the quarter. So that is up 17%. And if we look at the full year, 12.8 billion in 2021, 16.4 in 2022, or the year ending 2022. So that is up about 27%. That's looking good. And if we look at the weighted shares of average, the common shares, are they buying back their shares? Yes, they are. You can see they've bought back around 20,000 shares. More than that, because it's 1.074 billion compared to 1.054 billion. So they're buying back their shares. What does that mean for investors? Well, if a company has 10 shares and you own one of them, you own 10% of that company. If they bought back 5 of those shares, you would now own 20%, and therefore you would have more of those earnings per share. And in Home Depot's case, they are a positive earner, which would be very, very good for you. Now we want to have a look at the free cash flow. So let's go to the free cash flow statement. How do we get free cash flow? Well, free cash flow is the cash from operating activities, which is this line here, minus capital expenditures, which they nicely put from here. And what has happened? Well, you can see it's actually down. Net income, operating cash flow for 2021, year ending 2021, was 18.8 billion and compared that to 16.5. So that is down. CapEx, they have spent slightly more, 2.4 billion to 2.5. So what does that give us in terms of free cash flow for the year? Well, it gives us around about $14 billion in free cash flow, which is down from the previous year of 16.3. So that is a slight negative, but in terms of this company and its market cap, I think that's a free cash flow ratio of around about 23, which is slightly on the high side, but not for this type of company. I think that's still very, very good. So let's get into the models. What we want to do is we've calculated the future free cash flows, discount them to today's value, and gives a fair value based on these. So they see these numbers are not too bullish. This is the year ended 2021. Obviously, we need to update these, but this is calculating future free cash flows. What does that give us a value of Home Depot? Well, actually, this has a value of $389 a share, which means it's currently at a 23% discount. This is based on the averages of the last 4 years. Now, if we were to have a look a bit more conservatively here, as you can see that the net income has dropped slightly, but then I'd still say that this free cash flow is usually more than the net income. So let's just take some averages here, and that would be about 106%. So let's put the 106% in the free cash flow rate. Analysts are expecting around about a 5% increase And then they don't have the estimates for 2023, but you can see overall, this has, analysts are being a bit more bearish on the stock. So let's use their pre-existing numbers where they have been growing at about this rate. So that was 7.68%. And the net income margins, usually pretty similar, so I'm not going to change those. That would have the stock at over $425 a share, which is a 34% discount. And if we look back to what it was, this was before earnings when they were not as successful. You can see that it has previously got up to that value. So I think that is a very reasonable number on the bull case of Home Depot. And now let's have a look at the Buffett-Graham intrinsic value models. Takes earnings per share and expected growth rate into account. They have currently $15.59 in EPS, and the expected growth rate is about 13.6%. And yes, that is definitely a buy. $556.60 a share, which means it's at a 76% discount. So both of these models are saying it is a easy buy, which I do like this company, and it's nice to see that the models agree. So let's finally have a look at some of the technicals. Obviously, with this massive drop, with it being, 8% on the day, we have the 50-day, 100-day, and 200-day moving averages, 50-day in green, 100-day in yellow, and 200-day in red. So obviously, we've got some bearish signs right off the bat. The price is below all major moving averages. We don't quite have a death cross yet, but I'm going to expect that the 50-day will cross over the 100-day. These are your death crosses here. But that is still, if we want to go back in time, really, the last time we dropped under the 100-day moving average consistently was in April of 21, where it did it for a little bit. It only dropped for about, what was that, a month? Maybe a bit less than a month, sorry, 2 weeks. And then it rebounded very strongly. And the last time before that was in the pandemic. So usually this 200-day has acted as a pretty good, well, has never really been broke as broke the support level of the 200. So that is looking at a good buying opportunity because it is very rare for Home Depot to do that. Next, what I want to do is have a look at the RSI and the MACD, although we usually look at MACD first, so I don't know why I'm talking about that. So let's get the MACD up. Moving average, convergence, divergence. And okay, what are we seeing now? Very bearish signs. Obviously, the MACD and signal lines have switched here. Let me make this a little bit easier to see. You can see it switch and then switch back, so this is a bearish sign. Also, the MACD and signal lines are below the zero, which means it's also bearish as well, which would be a sell signal. And finally, if we look at the RSI, Relative Strength Index, is the stock in overbought or oversold regions. This is on the daily level first. You can see that this is massively in oversold regions, even more so than March of 21, and shockingly, more so than March of the pandemic, the COVID crash. So this is the daily. So this stock has usually trended towards the middle. So probably expect a good upswing there. And if we look at the weekly levels as well, the weekly I do prefer. You can see that it's not quite as bad as the pandemic, but still in massively oversold regions, which Home Depot is very rarely looking at this chart. So this could be a perfect opportunity to buy. And with the fundamentals of the company being very solid, I don't think it would be a bad decision at all. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it, and I'll catch you guys next time.